Thank you, Jennifer. Thank you, Secretary Geithner. Tim, 6 years ago, you were beginning a time as Treasury Secretary in a very dark period. It was a very chaotic, difficult time. If you could go back in time today and talk to your 2009 self and tell yourself where we stand in 2015 with the global economy, the global financial system, what would you be very pleased to learn about how things have turned out, and what would you be disappointed that has not gone better?
You know, in some ways, it's much better than I thought it could be, and that's partly because in that moment, in the fall of 2008, early 2009, I was not confident that we were going to get our arms around it, that we were going to find the way to avoid the world economy falling into a Great Depression. And it was terrible and scary, and we had no roadmap. And within 6 months, we were actually growing again as a country. And we were able to put out the worst fires of the financial crisis really remarkably quickly. So in some ways, it was better than I think we could have hoped. But of course, in many ways, we're still left with a terrible set of economic challenges. Some pre-existed the crisis, some the crisis made much worse. Lasting scars, huge damage to the basic economic security of Americans. It's going to have long effects on how people think about the world, how they behave. And of course, a tremendous lack of confidence in our political institutions, political system, and a very divided country, which is making it harder for our country to face the challenges we have ahead. In a relative sense, though, even with all our challenges, you'd like our challenges compared to those any other country faces. And I think our challenges today actually are a little better, a little more modest than they were before the crisis in some ways. And I think, again, that's largely because of the strategy we adopted in the crisis, because however unpopular it was, however messy it was, even with all its mistakes and errors, we ultimately as a country were able to put in place a dramatically forceful response to the worst crisis since the Great Depression. And our outcomes as a country were much, much better, not just than they could have been, not just better than the Great Depression, but I think better than what you saw in countries around the world caught up in this, mostly because, again, they adopted different strategies.
I'm struck, coming into this crisis, coming into 2007, 2008, there was a pretty good consensus among economists, even in the political system, on what you do when the economy turns down or when the financial system freezes up. Well, maybe I was naive. It seems like some of doing these things, the central bank being lender of last resort to the banking system, which I thought was pretty much resolved after the Great Depression, using fiscal policy to try and fight an economic downturn, using aggressive monetary policy. The act of doing these things that you and your colleagues at the Federal Reserve did and at the Treasury seems to have built the kind of popular opposition to them in the political system. Why do you think that is? Was that foreseeable? And does that tie the hands of the next person fighting a financial crisis?
Well, I think there is this thing about the systemic, the existential financial crisis, which is the kind of classic panics runs on banks, runs on financial systems, and they're different. They're much more dangerous, and they're different in part because what you have to do to protect people from their costs, to prevent them leading to mass unemployment, like in the Great Depression, you have to do things that are not just counterintuitive in many ways, but they're deeply unpopular. They go against the grain of the self-preserving instinct of every politician. They seem deeply immoral, if unfair, if not immoral, to the average person, because again, they require, at their core, actions which will look like you are aiding the arsonist, rewarding the arsonist, protecting the arsonist. And because of that, you're left with this fundamental tension that what it takes to protect you from terrible outcomes are actions that are going to be fundamentally deeply, it's going to evoke suspicion, anger, outrage, and I think lasting damage to people's sense about the fairness of the system. And there's no way through that. You could ask yourself, would it be better? Of course, many governments have tried this over time with much worse outcomes for their people. Would it be better to, step back and let the fires burn, not do those things that are so contentious politically, avoid the financial rescue? Would it be better to do those things? Would it be more moral, more just for the people, the victims of crises? There's no plausible argument for that. And I think there's no way to really reduce the political sting for doing it. If you look at the diversity of strategies adopted by governments around the world in this crisis, even with what you said is a rough consensus among economists, governments did very different things.
I may have been talking to too many economists.
Yeah, I think you were. The central bank's lender of last resort tools were used very reluctantly, very slowly, very gradually in lots of places, in contrast to what we did. Fiscal policy went into deeply damaging austerity in lots of parts of the world very, very early, in stark contrast to the consensus you described. And in the financial sector, there was mostly avoidance and gradualism, again, out of concern about the political costs of being more aggressive. But the economic costs of those strategies are much more unfair to the innocent victims of crises. They're much more damaging than the more forceful response that we were able to muster here.
So in your time at Treasury, you saw the American political system up close and personal in some very difficult days, not just the crisis and the immediate aftermath, but the Dodd-Frank legislation, the debt ceiling standoff in 2011. Does it all leave you feeling more optimistic or more pessimistic about our American system of governance and the way Congress and our system works?
Well, of course, it's deeply discouraging, I think, for any American. People used to come see me in Washington when I was in that job, and to talk about what we should be doing, what the country should be doing, and how terrible it seemed politically. And I always said to them, it's much worse than you think. It's much worse than what is apparent, the level of dysfunction, the difficulty of governing. But still, I'm a pretty optimistic person about this country. Still, beneath all the noise and the kind of pathetic adolescent political tone that captures much of the political debate, we're still a very lucky country. It's a very strong country with very strong institutions. And this country has been able to do things, even in the midst of that, that have tremendous long-term benefits for the country. And our challenges, they're more modest. They're more modest relative to those political weaknesses than is true for most countries. So we'll work through this. We'll find our way again as a country to recapture that pragmatic political capacity to govern, which is at the core of the American political tradition. We'll rediscover that again. It might take a little while, but we will. So I'm trying to be optimistic about that, though.
Was there a moment when you realized this thing's going to be okay? Was there a moment in 2009 or 10 when you said, maybe not we're out of the woods, but you can see the edge of the woods at least?
If you look back at that period, a lot of people think it turned in March, which was the low in the stock market in the United States, or it turned in April, May when the stress test results came out, or when growth resumed. But remember, we were living in a world where a lot of people thought we were going to fall off into the abyss again. We were living with the risk of a double-dip recession for a long time. A lot of people thought this was going to end in hyperinflation, or we were going to be like Greece, or we have to nationalize the entire system. And these are people with principled concerns about the challenges ahead. So I don't think it came quickly, and I didn't feel. I felt more confident that we were going to be able to prevent the financial system from falling apart. Sometime late in 2009.
Does the experience of that time, your collaborator, Ben Bernanke, had this view that if you can fix the financial system and keep it from falling apart, that gets you a long way toward avoiding a Great Depression, a bad economic outcome. Was that relationship maybe weaker than you thought? Was fixing the financial system not as powerful for?
I don't think. He's the economist, so I would defer to him on this, and he's a tremendously brave and wise and creative policymaker. But think about this. In the fall of 2008, by the end of 2008, the United States of America had put trillions and trillions of dollars behind, backstopping, reinforcing the financial system in capital and guarantees and loans and all sorts of, on a scale that was without any modern precedent. And yet, the economy was falling off the cliff at an accelerating rate, decelerating at a rate of, we didn't know at the time, but roughly 9% in real terms, annual rate in the fourth quarter of 2008. And even in early 2009, people thought we were living at the risk of still a risk of a second Great Depression. And why was that? It was because what we'd done in the financial system yet was still not adequate to leave people reassured there'd be enough capital to survive, but also because we had not yet deployed the other tools of policy on a massive scale that you needed to offset the collapse in private demand. And that was fundamentally going to require a more aggressive use of fiscal policy. This means tax cuts, temporary tax cuts, spending programs on a scale large enough to offset the collapse in private demand. And of course, it was going to require a sustained period of monetary policy, exceptional monetary policy stuff. So it was not sufficient, and I don't think Ben would ever said it was, to have just figured out a way to hold the financial system together with your whatever mix of duct tape and string, because those things were overwhelmed by the broader forces in the overall economy that were going to require larger support. And again, ultimately, what was decisive in the United States, again, acknowledging this was a terrible recession, and the scars were lasting, and it took a long, long time. It's taken a long, long time, even to make this much progress, bring unemployment down. But the things we did ultimately were successful was we were able to use this much more comprehensive strategy of massive fiscal force, at least initially, with very creative monetary policy alongside a very creative financial program. It was those things together that made them work. They would not have been effective in isolation.
The phrase necessary but not sufficient comes to mind.
That would have been crisper.
So the Dodd-Frank Act is now 5 years old. What is your level of confidence that we do have a more stable financial system, a better organized financial system than we did before the crisis? And what are the weak spots? What are the areas where there's still room for improvement?
I think by any measure, the financial system is much more stable today. And the reforms that we put in place, which were most importantly about trying to make sure that there are better limits on risk-taking, there's more capital against risk, and there's less risk of runs on banks. Those are much more conservative, they're applied much more broadly, and they will buy us have a good chance of buying us a long period of relative stability. But financial systems are very complicated, and you have to think about the system as a whole, not just the strength of what capital requirements buy in individual institutions. And these things are dynamic, and in a river, water finds their way around stones. When people feel more confident about the future and you have a greater measure of optimism return, then people are going to take risk again. And risk will migrate from where it's constrained to where it's not constrained. And ultimately, that'll create, over time, hopefully this will take decades, a set of risks familiar to those who looked at the system in 2007. Because if you look at the system in the United States in 2007, you had about a third of the system, maybe 40% of the system, financial system, that was constrained with capital requirements, however inadequate in their design, but constraining. And because of those constraints, risk had migrated outside that system, ultimately in a form that was larger than and largely overshadowed the banking system itself. And so you have to think about this as a complicated system where risk can migrate and will inevitably migrate. And so you have to think about this as to borrow Dexter Filkin's title, you have to think of this as the forever war. It's a never-ending thing. Reform has to be dynamic. It has to try to, you never be fully abreast of innovation and markets, but you try to, keep up with that.
So
unfinished business, though, should we do a little bit of that?
Absolutely.
Lots of unfinished business. We have still a deeply damaged mortgage market, still overwhelmingly and unhealthily dependent on the government. We have a oversight system of regulators which is ridiculously complicated and balkanized, and therefore weaker than it can be and should be. And we left the firefighting tools that are, unfortunately, but but always essential in an emergency. We left those firefighting tools impaired, weaker than they need to be, because life's uncertain, and in the end, you want to build a system that doesn't depend on the hope that crises won't happen. You want to build a system that gives you the capacity to act to protect people when the crisis happens, however unlikely it is. That's fundamental. So in those three areas, the housing finance system, and certainly in the regulatory oversight system, and in these emergency authorities, a lot of unfinished business.
So I'm struck that a lot of people in Washington see the banks and the financial sector in general as this very powerful entity. You helped to negotiate Dodd-Frank and make it happen. Are the banks too powerful in Washington? Is that a relevant concern?
I think that there is there's a thing that's characteristic of the American political system today, which is that there is a lot of power where there's money. It's not unique to finance, but you can definitely see it in finance. And it is a function of our system today, characteristic of our system today, that we as a country have made it too easy for commercial private interests to buy protection against rules that would affect the economics of their business. And that's something that Americans should worry about and try to change. And it's a broader challenge, but yeah, of course you should look at it, think about it in that area.
Sounds like no one sector, but a lot of private interests that have a lot of sway in Washington.
Yeah, it's more complicated than you think. Community banks are a major political force across the country, appropriately. There's 7,000 of them. They exist in every state on a massive scale, and they should have influence. So it's more complicated than is in the popular perception. But yeah, you should worry about it. You'd want, to the extent that you can, this is sort of like what governments learned over centuries of mistakes, that monetary policy is something that is best left removed from and outside of the influences of the short-term political considerations of politicians, because when you left it within their control, they normally did things that were terrible for economic outcomes. And finance is in many ways like that too. Because it's so complicated, because it's so vulnerable, because it has such economic consequences and costs, ideally you want the task of deciding how stable you want the system to be to rest with people who are as removed from political influence and as removed from private influence as possible.
There's been a thread of research coming out of the BIS, the IMF, that maybe a large financial sector is not really good for the economy, that maybe having a very large in terms of the size of the banking system, the size of the non-bank financial system, that doesn't actually result in faster growth or more productivity. Are you sympathetic to those arguments? Do we have too big a financial system in the US? Or?
I'm deeply sympathetic to the view that, and I bear the scars of this, that financial systems are inherently dangerous and they can cause terrible, catastrophic damage. And hopefully the memory of this one won't fade too quickly, so people remember that. But these are not problems beyond the capacity of humans to solve. You can build in better safeguards against risk-taking, combined with better emergency authorities in panics that have the chance of providing a much greater degree of protection to the average person against the failures of finance. And that's a forever worry. You should always be worried about that. But it's not something beyond our capacity. And we've done a lot to make that better. And again, just for perspective, the banking system of the United States, and today in the United States we define banks as including investment banks. The banking system of the United States—
You might have had something to do with that.
It has something to do with that. Is roughly, not a perfect measure, but if you look at their total assets, the measure of their size, is roughly 1 times the GDP of the United States. The comparable measure in Europe is between 4 and 8 times GDP. Canada's larger. Switzerland's 8 times GDP. really every other major economy around the world has, in terms of the definition of the banking system, much, much larger systems than we do, much more concentrated systems than we do, much less competition within them than we do. And I say that not to say that this is not a challenge we should worry about, but we got a lot of economic challenges in this country, and we have a finite political capital, limited ability to deal with many of the other problems we face that are going to make a big difference in people's lives. And we should put this stuff in perspective. And the achievements that have been made in financial reform are very powerful. They're not at the frontier of what's possible, and you always want to get them closer to the frontier. But we're in a much, much better position than we were in the decades before the crisis, and I think in a much stronger position than is true for really any major economy around the world today.
So I'm struck, since your book came out originally a year ago, the U.S. economy's looked pretty good and has gradually improved. Europe's looking a little shakier. The economic growth there has been disappointing, and now Greece is again at risk of, feels like the Greece story never ends. Feels like we've both been talking about it for 7 years or something. So if, do you envision a Greece outside the Eurozone? If their finance minister, Varoufakis, called up, what kind of advice would you give him? What is the outlook for this small country that's had a big impact on the economic history of the last several years?
Well, they've got a terrible set of challenges. I mean, for them, it's hard for them imagining being in, but they can't imagine being out, really. And I think it's sort of true for the rest of Europe. Much of Europe thinks it's hard to think about how you make Europe work with them in, but they can't really figure out how to make it work with them out. And they're going to be living with this problem for a long time. And their economic outlook has been much worse than ours over this period of time. But they had a much tougher set of challenges, much harder set of challenges. Not just because they're how many countries, how many governments, harder for them to work together. And if you put it's good to try to put yourself in their shoes. Try to look at these problems through their eyes. And what they're trying to do is figure out a way to hold Europe together, but with a set of institutions and reforms and policies that make it more likely Europe grows over time. And that means you have to create incentives for politicians and governments to do things they don't want to do. And they're having that balance today. They want to provide a level of reassurance to the world and to investors. People who have money in banks have to fund governments that they're going to hold it together, but they also want to keep enough pressure on governments throughout Europe to put in place the kind of reforms that are going to be fundamental to whether the thing is viable as an entity. And that's a very tough balancing act, and that's why it seems so familiar to you. And it'll be familiar 10 years from now.
So has their commitment to, the pain they're willing to suffer in a number of these countries to maintain the Eurozone, to keep on this path, has that surprised you, or is that?
No, it doesn't surprise me. Because my impression, just working with them and talking to them over that period of time, was they kept looking at the alternatives. They kept thinking about would it be better trying to redraw the lines of the euro area. Governments like the Greeks are trying to figure out it would be better to be in or try to leave, and they looked in the abyss, and they could not be confident that it would be easier challenge to manage individually as countries or collectively as the euro area by dismantling it selectively. And I think that judgment seemed sensible to me at the time, and I think it's likely to prevail, but obviously it's not a certainty.
Let's talk about China a bit. The Chinese economy seems to be slowing. There have been moments where it seemed China has been ascendant and taking a role on the world stage, especially the world financial system. How is that evolving? What is China's role in the 21st century global financial system?
Well, China's going through a economic transition that requires a period of slower growth. In many ways, you should look at the reasons why growth is slowing and be encouraged by that, because they're trying to fundamentally change the growth strategy they've had for decades towards a more viable model for the future, less export dependent, less heavy industry dependent, less polluting, less inefficient, a better source of growth for a different set of challenges. And it's very hard. That's a very hard transition to manage without going through a period of slower growth. And I think they've got although it's I think, an unprecedented challenge in complexity and not been successfully managed or navigated by really any country, they've got a better chance of coming through this than many, just because they have a lot of resources and pretty good instruments, tools to deploy, and a very competent, exceptionally talented group of architects of policy there, with more scope for maneuver, more room for maneuver than was true for many governments. So, yeah, they've got some challenges, and yes, they're slowing, but the things that are causing slow growth, and you see reflected in the slow growth, are a sign of their effort to try to build a better foundation for an economy that's going to be more viable going forward. Of course, China's, the rise of China, is going to be the most complicated. It's going to be the most complicated challenge on the strategic front than we faced in a really long period of time, and how we manage that, how carefully we manage that, will be fundamental to our security interests and those of not just countries in Asia but around the world.
Is your view that this role that Britain played in the 19th century economic and financial system, the U.S. has played in the 20th century, do they want that role? Do they want to?
Do they want to play that role?
Yeah.
I think one of the things that's interesting about China today is it's just hard to tell, and I'm not sure they know. What do they want? What role do they want to play? How do they want to use the tremendous increase in economic power they've earned and built up? And I don't think that's a knowable thing today. I think, and it's hard to look in Chinese history and see much that would tell you about that question. They don't have a history, as do many countries, of periodic, repeated expansionism. They don't really have that history. But not clear why that would be relevant for the future either. So I think it's just something we don't know, which is partly why this is such a dangerous period.
So I wonder if we could talk about some of the leaders you've worked with in very close circumstances over the last several years. Give us your honest opinion of their skills, weaknesses, what you made of these different people. So Barack Obama, when you're in the room with Barack Obama, what is your read of his?
Somebody said this to me about him, which I like as a thing. If they say professional athletes, if you ask them to talk about what it's like and what distinguishes the good ones, a lot of them talk about how it's their ability to slow things down, to slow the pace of the game, to see things evolve at a pace that allows you to think and react. And he has a tremendous calm and patience, which is a great strength. And I like that comparison. For me, I have tremendous admiration for him, and for me, watching him through that period of time, it's just you would want nothing more in the leader of a country, or typically in Washington or typically in government, people are trying to not to be too dark about it, but they ask what's good for me, or they ask what's good for me politically. Or they might ask first by what's possible for me politically. But my experience with him was, you started with what was the right thing to do, what was the necessary thing to do, before you went to what was possible realistically, politically. And if what was realistically, politically was well short of what you wanted, you thought was the right thing at that point, his view was, well, let's figure out how to relax those constraints. And I never felt, I was always confident. And he always said to us, your job is to figure out what was best, and he forced us to have a pretty brutal debate about that. But not to have our views about what's right constrained artificially by the limits that seemed to constrain us, and certainly not governed by what was in the short-term political interest of him.
Ben Bernanke.
Ben Bernanke, he's like the Buddha of central banking. But much more active.
Larry Summers.
Larry Summers, I worked for for a really long time, and then we worked together as colleagues. And if I was going to ask somebody about any issue and try to understand it from all dimensions, he'd be the best person in the world to talk to. Henry Kissinger said famously about him that, you should give him a job in the White House and keep him there for decades, working for presidents of both parties over time, because he's a better mind to think through complexity and what to do. So he's exceptional. He could be a challenge, but he's exceptional.
Elizabeth Warren.
Elizabeth Warren, we have a complicated relationship. I say that to protect her from saying too much. I'll say some nice things about her. We obviously disagreed on a lot of things. I'm sure we disagree on many things today, but we had a very effective and very consequential collaboration on what was in many ways the centerpiece of the reforms, which is the establishment of a better framework for consumer protection, based in a new independent entity with much more power than its predecessors had, and that was her signature idea. And I have a huge amount of admiration for not just the quality of the ideas she brought to that, but she brought tremendous force and skill to that task, and that's a huge, durable accomplishment, I think, for our financial system.
Last one, but the most delicate.
That might be. She might be uncomfortable with that compliment, but
Hillary Clinton.
Hillary Clinton. We sat together. I worked in her husband's administration, but a long way from policy and a long way from the White House, not geographically, but policy-wise. So my formative experience was sitting in the president's cabinet with her, and she's got tremendous judgment. We did a lot of work on China together, and she's strong, exceptionally smart, I think very pragmatic, and a deeply sophisticated view about the world, and I admire her too.
But did you have her private email?
I did not. I did not have her private email.
So if a future president, whether it's Hillary Clinton or someone else, calls you up and says, "Tim, we need you to come back into government," whatever the job might be, are you hang up the phone immediately, or are you going to take the call?
I love my work. I know people say it was so terrible. How it must have been miserable, but I loved my work, and I had the most amazing colleagues at the Treasury and the Fed over that period of time, exceptionally capable public servants. But I had more than my share of interesting jobs, I'd say.
So I don't think your wife would let you, from what
I
read your book.
Definitely some risk of that.
I'm struck in your book, and I've spoken to many of your colleagues over the years at various central banks and finance ministries. At some key moments in this crisis, there was a real sense of unity, a sense of purpose across borders, across different types of organizations within government. Can you reflect on what it says about this experience, and whether this is something special in how different countries, different institutions work together, and are there lessons for the future that future policymakers need to draw from that?
You never want to believe that outcomes for countries like ours are too dependent on the choices that individuals make and the quality of their relationships. But of course, it's not realistic to assume you can build a system, build a country, build a set of institutions that doesn't depend on that. And we were exceptionally lucky because we had not just in two presidents working together across the transition, but in Bernanke and Paulson, we had people with very complementary backgrounds, very different backgrounds, had not worked together before, but we had complete trust in each other. And we were able to debate and fight about what the right thing to do was, and disagree, and but always try to figure out, but we had to decide. We had to make some choices and figure out what to do next. And we were able to, ultimately do some fundamentally creative, exceptional things, in part because of the strength of that collaboration. And there was nothing in all the governments that I worked with over time around the world, and that came ever close to matching the strength of that relationship. And again, as I was saying before, to break these things, to take the risk of the Great Depression off the table, you need the full force of the institutions of a government like the United States working together, not in opposition. If you just look at Europe, not to be unfair to them, but they had somebody was putting their foot on the brake and someone was putting their foot on the accelerator, and they were a fight over the steering wheel, and it's a terribly damaging thing.
Well, the joke, they would have these meetings of Eurogroup finance ministers, and they'd come out, and 17 different finance ministers would go and talk to their domestic press about this and that. Unfortunately, that did not happen in the U.S. Fortunately for you, but as a reporter, I sometimes wished that.
We had our debates. I mean, you've written about these. We had lots of debates that became public debates about strategy, including within the administration. And debates are a good thing to have. They're a necessary thing. One thing I thought was great about the president was, how he forced our ideas, recommendations to go through a pretty highly contested process of debate among some of the great economic minds in the country. That was a very valuable thing. But what matters in the end is that not paralyze you. You're still able to recognize that you have to act, you have to choose, and you're going to make mistakes, and you have to figure out a way to be able to keep moving forward, keep trying stuff, keep doing stuff, and we were lucky, and I have so much admiration for those two men, Bernanke and Paulson.
And I understand you're working with Yale to help civil servants around the world kind of understand the lessons from different countries about these situations.
My experience was that even though these financial crises happen to some countries around the world on a global scale with a pretty appalling costs, and as you said, there's something familiar in them and the debates around them. So the body of knowledge among practitioners about what you actually do in the midst of the storm is terribly weak, and it's not accessible to the policymaker. In the U.S. that was true because it had been 70 years since we had a major financial panic, and so one thing I think I'm doing with a tremendously talented economist named Andrew Metrick at Yale is to try to build a master class for practitioners to try to better capture the experience of policymakers in this crisis, so at least we can give that to our successors. We're giving them a much better set of tools, tested in real time, many of them very effective, some of them not very effective, a lot of mistakes to learn from, but you want to give them those tools, but also a better feel for the choices we made, the decision making, the experience we made, and I think that'll, has some chance of improving the quality of future decisions.
So we're now to many of your questions. We'll try and get as many as we can. What role do you think culture played in culture at the financial institutions played in the crisis? Has it improved? Are there ways culture at financial institutions could improve? We've seen post-crisis scandals on LIBOR, on all kinds of things. What role is there in improving culture in financial institutions?
It's an excellent question, and I don't know. You can't regulate culture. You can't regulate prudence. You can't regulate virtue. So you have to design a set of incentives and rules that protect you from the risk that in booms, in periods of excessive confidence, you attract a lot of people to finance who you may not want to have in finance, actually. And I think that's a hard challenge. But you don't want to. You have to design a system that is, we live in the real world, and you have to design a system that protects you against the risk that people, and whatever their motives, if it's just too much confidence, too much optimism, or if it's just pure predation or fraud, you have to design it to protect you from that, because you can't assume it away or assume you can design culture that banishes it from humankind.
At the start, you mentioned errors and mistakes that were made. What are they? The questioner asks, is AIG one of them? And what is?
I think we made, as a country, I think we made, there are three really consequential things that mattered in terms of how severe the crisis was, how great the damage was. And we were relatively late to escalate. The crisis started, in some ways the panic started in August of '07. And although we escalated gradually ahead of many countries in the United States, obviously it was only with the collapse of Lehman and WAMU and the panic of the fall that as a country we were able to muster the political will to put massive, overwhelming force behind the strategy. And that was late. It was not late because we thought it wasn't scary and damaging. It was late because we didn't have a set of institutions and tools and authority that were powerful enough. We had to go to Congress to get them. And I think the second thing that was very consequential is that fiscal policy, although it was very, very substantial, very powerful at the beginning, it faded very quickly. And those tax cuts and spending increases, which were absolutely vital, they were overwhelmed very quickly by first the contraction at the state level and then ultimately by the reforms Congress passed that brought a bunch of austerity a little too quickly. So our deficits came from 10% of GDP to 3%, below 3% of GDP, which was good. It's good they're down, but they came down very fast. And that was, took at least a percentage point off growth rates for 3 years at a time when it would have been very helpful to have a little stronger growth. So those are two broad areas in strategy. And there were, I would just say beneath those, we were very, very late in housing. Scale of things we did in housing were very weak relative to the size of the problem. We were never able to relax the basic constraints on our choices enough to deliver better outcomes in that context. So those are three.
Sounds like not AIG, not the details of some of the bailouts in that fall of '08, or is it just too technical and too?
Well, I don't. Maybe the fair way to think about it is to say, what would be ideal if you had perfect authority as a rich country, tremendous resources. How would you optimally design the? It's like triage in medicine in many ways because, you want to design a response where you're making sure you protect the economy from mass unemployment, and the system itself doesn't break down because you can't have the lights go out across the economy. But you don't want to protect everything. You don't want to try to preserve a whole bunch of things that were built in the boom that were not viable anymore. So you have to be able to draw some broad boundaries around what was essential and protect that from the contagion and the pressures that come from the failures that were going to happen outside that. And that's a messy, completely imperfect art. And you could, if you could go through the natural experiment of saying, if you had perfect authority, and you could have designed that, drawn that moat where you wanted to, where you've done it, people would have disagreed on that. And, ultimately, we designed it around the essential, I think, and we're able to protect that. But there was a lot of damage and mess in getting to that point.
These are two kind of related questions. Is the U.S. in danger from the disappearing middle class? And do you view inequality as a problem that financial reform can address or should address, or should we think of those on separate channels?
I think this basic mix of challenges, people sometimes say it's about inequality, but it's a really more complicated set of things. It's about the really appalling levels of poverty we still have in this country. It's about what's happened to the median income, which is, it's moved sideways for a pretty long period of time. It's about what's happened to people's, the quality of opportunity people have across the country. If you're born poor or black in the United States, the quality of healthcare you get, the quality of education you get is appalling relative to what's available to people born with more modest fortune. And of course, there's, a decades-long trend of widening inequality. And I think that mix of things, that captures some of the most daunting challenges we face. I think this question about whether financial reform helps against that is something I think is very interesting, but I don't really understand the case for that, certainly not relative to a whole range of other things that some of which we've done, some of which were inadequate, some things you can do through the tax system or through the structure of the safety net, the quality of educational opportunity you give people, the quality of healthcare you give people. Those things seem to me to have, how you think about the minimum wage, those things seem to me to have very powerful benefits, much more powerful benefits. And we're not, again, not at the frontier of exploiting those. So, but I'm not sure, don't see it. I would do other things first.
So the question asks, what's the next bubble to burst? I'd add, we've seen a bout of volatility in the bond market the last few weeks. It's not the first time that's happened in the last couple of years. Is the unwind of all this extraordinary intervention, is this a dangerous period for markets and the economy? And as the questioner says, what is the next bubble to burst?
Well, the thing about bubbles is you don't really know until after the effect, and even after the effect, after the fall, it's hard to discern at that moment which ones are damaging, which ones can really hurt the performance of the economy. I think it is true that the world's going through this. We're in uncharted territory in many ways because we've had such a long period of exceptionally accommodative monetary policy, and that induces a lot of distortions, changes a lot of things about the structure of financial markets and incentives, and it means that, and necessarily, as you go through a period of tightening, even if it's tightening driven as it will be in this country by the reality of a stronger economy, it'll bring with it more uncertainty. And some of these changes in the structure of financial markets that were a consequence of the reforms create a little more uncertainty too about the impact of any monetary policy change. So yeah, I think there's going to be some uncertainty around that and some messiness around it. But as central banks transition, it'll be because economies are fundamentally more healthy, more people are back to work, you're closer to fully employing the resources of the country, you're in a stronger position to withstand those things. And the financial system itself, and this is really fundamentally important, has much better shock absorbers to absorb these things, these periods of volatility or stress than they did before the crisis. And those are two fundamental things that'll help.
So we kind of talked around this a minute in the earlier question, but a bunch of people asked a version of this, so let's do it. Was letting Lehman Brothers fail a mistake?
I think, and I know it's hard for people to appreciate this, but I want to just emphasize this. I think Americans still believe and still live with this perception that we vest the central bank and the president with vast emergency authorities and discretion to protect people. And that is true to some extent in national security. We give the president the ability to do some things quickly in response to existential threat. But in finance, we don't do that. We don't do it in banking. We don't do it in the central bank. And we don't do that. Why don't we do that? We don't do that because there is this deep fear in financial systems about the moral hazard risks of creating too much discretion for standing emergency authority. And so we went into this crisis with very limited authority at the Fed and almost no authority in the executive branch to deal with the worst financial crisis since the Great Depression. We had some tools to protect banks, but we did not have tools to prevent the failure of large, complicated other types of financial institutions. Didn't have that authority until TARP, until Congress passed the emergency measures. And so we went into that terrible period of the fall of 2008 with very weak tools, and we felt we had no legal option in the absence of a willing, stronger buyer of Lehman to prevent its failure. And when the British, after considering buying Lehman, decided it was too weak and their firm was too weak, prevented that, we were left with no good option. I wish it were different, because in a crisis, in a panic, fundamentally you got to err on the side of doing more. People hate it, but you got to err on the side of doing more, not less. And that was an example of the costs of letting something burn, letting a crisis burn too hot. Didn't have the defenses, the protections to prevent it from being very damaging. And it was very damaging, but in the absence of a willing buyer, we had no choice, no plausible option.
So how do you feel about your public portrayal in Too Big to Fail and other...
Can I just say add on one thing in this? I think that, people, they'll listen to that answer, and they'll say about Lehman, and they'll say, yeah, but you did AIG the next day. How could that be possible? They weren't a bank. But the authority that Congress gave the Fed, the emergency authority, allowed us to lend to non-banks in emergency, but only against collateral where there's a plausible source of repayment. And in AIG, as history has borne out, there were very profitable businesses around the world that we could lend against on a scale that was large enough to protect the firm from collapse. But the authority Congress had designed for us, for the central bank, did not give us the authority to do that in the context of an institution where we couldn't lend against, on a scale, against collateral large enough to prevent collapse. So I'm sorry to give such a complicated thing, but that was the reality we lived in.
This is the classic insolvency versus illiquidity debate, and you were pretty convinced when you did AIG it was just illiquid, not insolvent. And Lehman, it was a much harder case.
Yeah, these things of liquidity solvency, they're fundamentally gray in a panic. They're not really knowable. So you got to make a judgment. But in those two cases, the choice was very stark.
So how do you like your portrayal?
Oh, I haven't seen that movie yet. I did read the book, but only after I wrote my book because I wanted to make sure I was writing on my memory of the crisis, not on the memory of others.
There's a bigger question. You've been kind of an unwitting public figure. You didn't go into your line of work expecting to be a public figure, but starting maybe early '09, you were. How has that experience been, and what do you think people might misunderstand about you?
Oh, I don't know about that. It's hard to answer that. I mean, large parts of the country think I grew up in Goldman Sachs still, although.
Well, I hope now that you're in private equity, at least you're actually in the financials.
I think your former paper actually wrote the first authoritative article that stated in early '09 that I spent my life at Goldman Sachs rather than as a civil servant. So I live with that. I live with that perception. But it's as you saw me struggle. It's not my natural thing. No experience doing this. I remember when I first met the president when he was then the Democratic nominee in October of '08. And he asked me to come see him, and I went to see him. We didn't know each other at all. And he said, well, I might have to ask you, if I win the election, I might have to ask you to come to Washington. I said, well, you shouldn't do that. And I had a long list of reasons why you shouldn't do that. And one of those reasons was that, I wasn't a public figure. And, in a financial crisis, you want somebody people have seen and felt, got to assess the quality of those judgments, and I don't think I'd been on TV before. So really? it was a challenge, and obviously very hard for me.
So what are you doing at Warburg Pincus? How's the private sector treating you?
I am enjoying trying to learn something relatively new, and it's a very different world, as you'd expect. It's pretty far removed from politics. Pretty as far removed from what I used to do as almost as far removed as almost anything I could imagine. And it has this fundamentally. It has this nice creative process to it because you're fundamentally trying to decide whether people have a good idea, whether they know how to build something from that idea, and it's a very tangible, can be very appealing, satisfying thing.
So as you reflect, we'll close here, but reflect on, you spent a long time as a civil servant. You were a young Treasury attaché in Tokyo during their boom time. You worked on the East Asian financial crises in the 90s in the Clinton administration. Can you talk about the role of history, not just the recent stuff that you witnessed, but more distant history, in understanding what was happening during this crisis and responding to it? And are there any lessons you take away about what our public servants need to do to understand the world they inherited and how to not mess it up?
I think, maybe this is a somewhat one step removed from your basic question, but I think it's very important to recognize a fundamental thing, which is that a huge number of the challenges we face as a country are going to require things only governments can do, in terms of the incentives people operate with, the constraints you impose on them, the resources you give them, things the markets can't finance. And to have the chance of better outcomes from government, you have to figure out a way to get people willing to work for their country. Not necessarily for their entire careers, for part of their career. And you have to figure out a way to create a system where it's appealing and possible for people with diverse experience from all walks of life to come work for their country. And if you do that, you have some chance of getting better outcomes for things that are going to matter for our challenge. If you don't do that, it's going to be much harder. And this does not mean that the government is the solution to all problems, because of course it's not. And governments can do lots of damage too, but whatever you think on that basic spectrum, you have to design a system where you make it more likely, not less likely, that you can have talented people come and serve in these roles. And I would say that I felt I had the most extraordinary experience because I went there when I was 28 and basically did one thing throughout my professional life. And I worked throughout that period of time with civil servants, career civil servants who were, just terrifically ethical, competent people, creative people who were trying to do their best with very bad choices and navigate through a period of uncertainty where, we were going to do hugely consequential things. And we just got to figure out a way, and I think this is fundamental to the political challenges we face, to make it compelling again and make it possible for people to be willing to come do this. I was so lucky that I had the chance to do it. And there are so many talented people still there, but you got to get more people willing to do this.
We will close there. Thank you, Timothy Geithner.